Welcome back to Beyond the Stock Market, a Groundfloor production. I'm your host, Brian Daly, CEO of Groundfloor, and we're back for part 2 of our conversation with Stacey Schacter of VION Investments. Stacey, thanks again for being here. Let's jump right back in. I want to continue the conversation, talk more about private market trends, as well as get into what's new around the industry. All right, so let's start off with this. Where do you think we are in sort of a broader market cycle right now? Can you provide perspective based on your years of experience? Like, how would you characterize it, and what signals are you watching most closely related to that?
So it's a great question. I would say if we want to talk about the United States in general, we're certainly late cycle, not recessionary. Growth is positive. Labor seems to be holding up despite AI. The yield curve is not inverted. But I think of things as just being fragile. And between wars that aren't wars and more tariffs being threatened, the market generally and companies hate uncertainty. And that uncertainty can sometimes cause erratic behavior. It can cause people who were going to spend not to spend, although that doesn't seem to be happening, right? People seem to still be spending despite the high inflation. I mean, we just saw inflation came in at 4.2%, I think it was, due largely to the cost of gasoline. But all that takes money out of people's pockets. It takes money out of companies' pockets. And I don't know if we truly know the effect today. We will see the impact 4 to 6 months, maybe from now. And you are seeing corporate bankruptcies rising. I think you're also seeing consumer bankruptcies rising, although I don't have the exact numbers. I haven't looked most recently. Core inflation is still above where the Fed wants it to be. And the thought of having interest rate cuts, I think, is definitely off the table. And all that means is higher interest rates for consumers, higher interest rates for businesses, a depressed mortgage market. And yet we still seem to be pretty resilient despite all of these things.
Right.
So what I always tell people is there is always distress. There's always distress. There was distress in the oil and gas market. Now oil and gas is like going through the roof.
Yeah.
And so that's really helped those industries. So who's being hurt? You can always find, it doesn't matter if it's boom or bust. There's always companies or sectors booming, and there's always those that are busting. One area, you could say is been talked about a lot is the education area. You have candidates saying, hey, we don't need a 4-year college system. We need one that's faster and that will help, train for AI. But I'm not saying that that's the right answer, but you just now have people looking differently at the economy than they used to. You have, I was listening yesterday to, I don't remember if it was CNBC or another station, talking about how the Trump administration and others want companies that are responsible for AI to give something back to the people. I don't know what that means, what it looks like.
Right.
So now you bring it down to our sector. How does that impact things? Well, I think money is tight. People are, and it really is two worlds. And I don't know if, unless you're involved in that world of people trying to live paycheck by paycheck, if we truly understand it.
Right.
But that divergence, I think, is certainly increasing between the haves and the have-nots.
I mean, certainly if you own assets, life has been great, and by all accounts could continue to melt up to become even greater. And if you don't own assets, financial assets in particular, it feels like people are being left behind. I think that's the observation that leads people to talk about this K-shaped economy,
That's
Right.
right. That's right. And you nailed it on the head. It is a true K-shaped economy, and people who have 401ks feel rich.
Yeah.
And I know there's been a couple of down days here recently, but for the most part, the market is doing really well. But not everybody has that safety net.
Right.
And now
Well,
they're talking, we joked about Social Security, and yeah, that's going to run out of money in 2038. Is that what I saw?
2030,
Or
2031 is
2031?
the
Okay.
year that they project the uh, the amount of money coming in will be outstripped by the money going out. And well, no, that's already the case. But by then, they won't be able to afford. Uh, they'll have depleted the trust fund such they won't be able to afford the balance, and they're going to have to cut. You know, some
Right.
people say as much as 20 or 30%. Of benefits if
And
they
we've
don't
been
increase
talking
payroll
about
tax.
this. Yeah, we've been talking about this issue for decades now, and it would have been a pretty simple fix. Another fix is, well, people are living longer. Shouldn't the retirement age be moved up?
It's another thing
And
it's another dial they can turn and have.
but
Yeah,
imagine the protests. And so it's a complicated
it's
world,
competent. Yeah,
and it's made all that more complicated by an economy that is sort of topsy turvy
yeah.
and erratic.
I,
So, but I don't see recession coming, but that doesn't mean it's certainly a rosy picture. I mean,
right,
we added more jobs than people expected, but are they the right kind of jobs?
right.
So you always, like with all data, you have to dig deep into it.
Yes,
The Fed puts out something called a beige book. Um, Interesting read if you ever read it. I say that somewhat tongue in cheek. Now, I guess you take it, you drop it in Claude. Claude will spit something out to you. Oh, this is what it says.
right.
But
Much better. Just more
you
represent.
know, I don't think so.
Yeah,
I don't think so. You can't let just because Claude says it or any of these
right.
doesn't make it true.
Yeah,
And I use AI a lot. I built my own open claw machine, but you have to understand how it comes up with the answers in order to properly utilize the data.
yeah, for sure. Um, so we're late cycle.
Yes.
We're fragile. I like that word. I think
Mhm.
there's maybe less room for error. There are more things that can break and cause problems, second and third order problems. But if you zoom out and look ahead 5 to 10 years, let's assume we get through late cycle. What do you think is on the horizon? That'll have the biggest impact on these markets. I mean, whether it's consumer or commercial or both. I mean, presumably we'll get through whatever the late cycle resolution is. What do you think is beyond that horizon?
I think uh, rather than midterm, if you talk long term, and so let's call midterm 5 years
Yeah,
and longer term 10 years plus. And I think they're two different markets. I do believe that we're going to see a lot of dislocation with AI. But oddly, when we've seen similar things in the past, the inventions of the car and many other things, people thought a whole bunch of jobs would be lost. And in fact, the opposite turned out to be true. So with the invention of the computer, people thought all sorts of jobs would be lost. But in fact, companies had to hire all those people to run and understand those computers.
yeah,
So yes, we will see a great loss of jobs, at least probably in the beginning, and a great retraining of the world. But 10 years from now, I'm a pro, I guess, AI guy. And the fact that I believe it is actually going to do wonderful things in medicine and other areas that will stimulate the economy and make the world a better place. Though there is a decent chance of significant harm, including, and this is coming from the people who invented AI, or not necessarily invented AI, but who have capitalized on AI, whether it be OpenAI or some of these others. I mean, there's a greater than zero chance that it annihilates all of humanity. However, the Stoic response is, there's nothing I can do about that. So I focus on that which you can control and accept that which you cannot. So if you look 10 years in the future, I think you're going to see actually a huge employment boom brought about by AI being used as a tool instead of as a replacement, for the very reason that AI, like I said before, you have to understand it. If you're just using something, it's like, well, this is what it says, I guess it's right.
Yeah. You have to
It's,
understand how it got there so that
yeah.
you can assess for yourself, and ask the follow-up questions. Like if you ask enough follow-up questions, you start to realize some of the weaknesses, in the initial perspective that maybe your model is producing, right?
I mean, yesterday I was using AI for something, and this one was chat, and it gave me a response, and I looked at it and I said, well, this isn't right. And I typed in, I think you did this. And it came back and goes, oh yeah, you're
Oh,
absolutely right. I
yeah.
made a mistake.
Well, no, it reminds me when I was an analyst right out of college, working on consulting, in management consulting, and, there'd be these sophisticated models to predict all kinds of things, and sort of financially or operationally. And, the way I was taught is, yes, the Excel model is wonderful, but the Excel model is built on a stack of assumptions that if you don't understand, you know, you got to look at what the model tells you and you got to question it, then understand how it's getting there. And that's how you debug it. And that's how you improve the model actually,
Yeah.
right? Is by going back to Claude and say, wait a minute, based on
Well,
my experience, you may have been thinking about it this way. It's the kind of thing that like a partner would tell an analyst, or an associate at a
yeah,
firm.
no, you're right. And if you remember when fintech first came out and was a thing, I was going to conferences that go, we have a proprietary model. I always use the word proprietary. We have a proprietary model, and we have 50 different attributes that we put in to analyze whether or not a customer is going to be a good credit risk. And I wouldn't do business with those companies, because when you have 50 parameters, switches, think of on and off, and then you have 50 things that can go wrong in that model that can greatly distort the result. If you get one of those things wrong, it throws off the entire model.
Right.
I like the people that said, yeah, we have 10 to 12 things that we look at primarily.
Yeah.
Are they employed? Do we, we do employment verification,
Yeah.
whatever, and yes, you use the data, but you use it in a way that's smart. And then you end up being almost too smart. And
Yes.
you bring in anomalies that you didn't need to bring in. Like, okay, we go beyond the zip code. We look at the street they live on. Okay.
It reminds me of when we were trying. I was not a real estate person before I started Groundfloor. I wasn't even a finance person, and we needed to come up with a model, to assess risk, in some sort of repeatable, quantitative way. And having little experience in that, I was dumb enough just to go talk to people, who had been underwriting credit in the space to just find out like, how do they do it? And I learned, I think our first model had 8 data points, that we looked at.
That's pretty good.
And 8 was
Right?
great. And then maybe we added a couple more and then we did some refinements as one does over time, as you learn from it. But I'm glad we started from 8 that we could understand, you know? And there were some elements in there that I wouldn't have thought of as immediately relevant that, you know, turned out to be highly explanatory, that in our early algorithm. And so I'm glad I didn't take that scattershot 50, to try to sound impressive and,
Yeah.
flex our muscle, about what we know, because, well, the truth was we didn't know that much. So we we had to simplify it. Fortunately, I
Yeah.
think it's probably why we survived through, these different interest rate cycles and, in our space, a lot of change in the
Yeah.
last decade.
I'll tell you, whenever people ask me though, what are the signals that I look
Yeah.
for a problem? It's, you have the things that signal ahead of a problem. Of course, credit card, auto delinquencies, consumer loan charge-off rates, small business default rates. And then C&I loan demand,
Yeah.
tightening, and even in private credit, is it covenant light, or are they beginning to add more covenants into it?
Yep.
You can watch yield curves as well. Most of the information we get is stale,
Oh yeah.
but there are certain signals, and there are certain, like the New York Fed is really good at putting out some information that anybody, and they do it in charts. So it's really, really nice. I'm a picture guy myself. And you can sort of look at things, you go, this just doesn't look right. And then you can compare it. And that's where you can take that stuff, drop it in AI and say, hey, do you see anything here that I'm missing?
Right.
This is what I think. Tell me why I'm wrong.
Yes.
Is a better
I
question
like.
oftentimes.
I definitely want to go back to your sort of medium term and long term view, because it's intriguing. I think I'm in line with you. I do think this K-shaped economy has to be resolved somehow. It sounds to me, these are not the only two ways to solve it, but a lot of people talk about political solutions, universal basic income, some sort of redistributionist kind of, politics, or political solution. Jeff Bezos was recently quoted as saying he thinks the bottom half of earners just shouldn't pay any income tax at all. Why bother? So there's a political aspect to this, and it feels like the politics will be significant over the coming decade. I like what you described about the impact of AI, because it also points the way to there being a market-based solution, right? That, you know, I, if you're a techno optimist, you think, well, technology will save us eventually, right? Through some disruption. But it sounds like you would cast your lot more with sort of the market and technology evolving in a way that solves some of the K-shaped issues more than the political. Or do you feel like it has to be both, or maybe more
Well,
political? I mean,
yes, it absolutely has to be both, because all you got to do is let a politician get involved. And I majored in economics as well as accounting, and the market is overall pretty darn efficient unless you do something to screw around with it. Now, there are times when you have like a natural monopoly that might need to be broken up, and we may end up with that with AI. But AI can be a great equalizer, because now somebody who doesn't have a lot of resources doesn't have to spend a lot of money to get access to the world's knowledge.
right.
However, if you think about places, for example, in Africa, or uh, Eastern Europe, or that don't have as much resources as the United States and other countries have, I could see where the ownership of this technology will push those countries further ahead and other countries further behind. But the use of the technology, I think, can really help a lot of people from starting a business. And I think that is the one thing you're going to see. You're going to see a lot of people who were dislocated becoming entrepreneurs and using this technology for things that people can't even imagine. And I can't imagine what they are, but that you don't need a huge stack of money to start a business now with this technology.
Right.
So I think you're going to see this rotation of people moving into new fields that, okay, I'm AI consultant. Okay, fine. There's going to be, plenty of those, but an AI consultant who focuses on, you know, all these different sectors. And then you'll have people coming in and rolling all those companies up. And
Right.
there's this flywheel cycle that goes on.
It certainly
If you,
happened. It certainly happened in the late 90s and early 2000s when the web itself was coming of age, right?
That's right. That's right.
Certainly
But the
happened.
biggest, the biggest issue I really see is debt. Um, that's sovereign debt.
Yeah.
One of the reasons we're as strong as we are is because of the dollar.
Right.
But if the dollar weakens or is no longer needed, then there's a lot of pain and suffering that could put us into a great recession. I'm sorry, a depression rather than even a great
Yeah. I
recession.
mean, people don't think about the impact of that. since 1971, at least, and arguably earlier than that, we've lived in such a favorable environment for the dollar. Like, it's just dollar dominance has been powerful in
So if they can, and now I don't know who Lay is, by the way. So if the dollar is no longer the currency of the world, and I'm not saying it's going to be Bitcoin, but then that is the most serious threat probably to the U.S. economy,
yeah.
because then our cost of borrowing will go through the roof and we will no longer be able to pay our obligations. There'd be massive, I mean, there's a whole roller coaster of things that would happen. I would encourage your readers to go to Ray Dalio's site and read his commentary about that.
Yeah, the big debt cycles, or the big debt
we're
cycles
just
are
being
fascinating.
irresponsible at this point.
For sure. All right. This has been great. I really appreciate you taking the time to do this, Stacey. So we like to wrap up these conversations with a rapid fire Q&A. Let's see if we can knock a few of these out in sort of one sentence. Whatever comes to mind is perfectly fine. What's the most misunderstood concept in investing?
Oh, God. One sentence, huh?
Yeah, if you can, whatever comes to mind.
That return equals wealth.
Return equals wealth. Solid.
Yeah. So in other words, another way of saying it is you can't eat IRR.
Right.
You have to have absolute return.
Yeah. Multiple on invested capital, for example.
Yes, that's right.
So what's the biggest mistake you see investors making right now?
You already mentioned it. It's the FOMO. Jumping in to something after the smart people have jumped in, and then you have all the followers, by then it's typically too late.
And I know you've been patient, so now I have to ask, when has your patience been a regret? Like, is there a deal that you passed on that you still think about?
All the time. There's not just one deal, there's several deals. Especially during the Great Recession, there was another bank we had an opportunity to acquire. We thought, well, it'll be there, and it wasn't. We've had several opportunities pass us by because we were, doing diligence. Others were jumping in, and we try and be thoughtful, and sometimes speed does win. And we were not fast enough in those cases.
So we live in a little bit of a hype cycle. What's your favorite, most overhyped trend today in finance?
The most overhyped trend in finance? I think subprime credit cards.
Subprime credit cards. Or is too many people piling into that, eh?
Right. Too many people piling into that. And there's only so much that cohort can actually absorb.
All right. And then I've got one more to wrap up. If you weren't in finance, if you hadn't been led down this path through the story you shared last episode, what do you think you'd be doing instead?
Oh, one of three things. One, continue to practice law. Two, I actually started a farm.
Awesome.
So maybe actually just leaving law altogether, being a farmer. The third one, this is absolutely true. When my wife and I we had two girls, and they were very young. My wife worked for Chiquita, and she used to go to Central America all the time. And she said, Costa Rica was so beautiful. We should just sell everything, move down there, and start up a boat business that does like parasailing, and just throw it all to the wind.
Literally.
Yeah. And I do sometimes wonder, what if we had done that? Where would we be now?
That's always fun to think about, alternative paths.
I call them sliding door moments.
Sliding doors. I love that movie. That was that Gwyneth Paltrow? Is that the right actress?
I'm not sure. I just remembered the door closed. She went back, saw her husband having an affair.
Right.
And the other time she walked through and she knew nothing about it.
I mean, I think that was in the 90s or so, or maybe 2000s.
And people have sliding door moments all the time that define their life.
I agree. It's fun to think about that. All right. Well, let's wrap up. I really appreciate you joining us on the podcast, Stacey. For our audience, you can visit VIONINV.com, VIONINV.com. to learn more about Stacey's firm. We'll also share Stacey's LinkedIn in the show notes, and I'm sure you can reach him that way. You can check out all of our podcast episodes at groundfloor.com/podcast. Thanks everybody for tuning in.